Hello everyone, welcome to Business School 101. Today, we're diving into a fundamental course in any business school, corporate finance. Whether you're managing a small business, overseeing a multinational corporation, or tracking the stock market, corporate finance plays a critical role in every financial decision a company makes. In this video, as an introduction to the course, we'll explore what corporate finance is, the major areas it covers, and why it is essential for businesses of all sizes and industries. Section 1. What is corporate finance? Let's begin with the basics. Corporate finance deals with how businesses manage their financial activities. It focuses on making key financial decisions to maximize the value of the company for its shareholders. Simply put, corporate finance is about managing money in a way that benefits both the company and its stakeholders. Section 2. Three main areas. In general, corporate finance covers following three main areas. First, investment decisions, which refers where should the company allocate its resources for the best return. Second, financing decisions, which refers how should the company finance its operations, through debt, equity, or a mix of both. Third, working capital management, which refers how can the company manage its short-term assets and liabilities efficiently to ensure smooth operations. These decisions require careful planning and analysis to maximize shareholder value while minimizing risks. Let's discuss them individually. Number 1. Investment decisions. One of the primary roles of corporate finance is making investment decisions. This is also known as capital budgeting. It's the process of deciding which projects or investments will generate the highest returns for the company in the future. Companies must evaluate these potential projects carefully to determine which ones are worth pursuing. To make better investment decisions, the following analyses are often applied. Number 1. Net present value, NPV. It evaluates whether a project will add value by comparing the present value of cash inflows with the initial investment. Number 2. Internal rate of return, IRR. It measures the expected profitability of an investment. Number 3. Payback period. It estimates how long it will take for an investment to repay its initial cost. For example, imagine a small bakery owner considering investing in a new oven to increase production. Using capital budgeting tools like NPV and IRR, the owner can determine if the upfront cost will be offset by future sales growth. If the oven boosts production to meet demand and increase profits, the investment would be worthwhile. The owner would also evaluate the payback period to see how quickly the cost can be recovered, supporting the bakery's growth and competitiveness. Number 2. Financing decisions. After a company decides to invest in a project, the next step is to determine how to finance that investment. This involves making decisions about the company's capital structure, the mix of debt and equity. The goal is to find the right balance that minimizes the cost of capital while maximizing shareholder returns. Option 1. Debt financing. It refers borrowing funds through loans or bonds. Debt can be cheaper than equity because of tax benefits. Interest is tax deductible, but it increases the company's financial risk. Option 2. Equity financing. It refers raising money by selling shares of the company. While this doesn't require repayment, it dilutes ownership, which can be a concern for current shareholders. For example, a mid-sized toy manufacturing company plans to expand its production line and needs to raise capital. It can either take a loan, benefiting from low interest rates and tax deductions but increasing debt risk, or issue shares, which raises funds without debt but dilutes ownership. The decision between debt and equity financing is often influenced by market conditions, the company's financial health, and the risk tolerance of its managers. Number 3. Working capital management. Corporate finance isn't just about investments or raising capital, it also involves managing the day-to-day finances of the business. This is where working capital management comes into play. Working capital refers to the short-term assets and liabilities of a company, such as cash, inventory, and accounts receivable. The goal of it is to ensure that the company has enough liquidity to meet its short-term obligations, such as paying suppliers, employees, and other operational expenses, without holding excessive amounts of cash or inventory that could be better invested elsewhere. The working capital management normally include following components. Number 1. Cash management. It refers ensuring the company has enough cash on hand to meet daily expenses while minimizing idle cash that could be invested. Number 2. Inventory management. It refers keeping inventory levels optimized. Too much inventory ties up capital, but too little can lead to stockouts. Number 3. Accounts receivable and payable management. It refers ensuring customers pay on time and negotiating favorable terms with suppliers. For example, imagine a grocery store where the owner manages cash for daily expenses like restocking shelves and paying employees. They must optimize inventory to meet customer demand without overstocking or waste, and negotiate good payment terms with suppliers while ensuring customers pay on time. Effective working capital management ensures the store stays both liquid and profitable. Section 3. Why corporate finance matters. Corporate finance is crucial for businesses of all sizes and industries for the following reasons. Number 1. Maximizing shareholder value. The ultimate goal of corporate finance is to create value for shareholders. This involves making sound investments, maintaining an optimal capital structure, and ensuring efficient day-to-day operations. Number 2. Managing risk. Corporate finance helps businesses evaluate and mitigate financial risks. Whether it's interest rate risk, credit risk, or operational risk, effective corporate finance practices allow companies to navigate uncertainties and remain profitable. Number 3. Ensuring liquidity. Working capital management ensures that the company can pay its bills and meet obligations, preventing financial distress and ensuring smooth operations. For example, after the 2008 financial crisis, General Electric, GE, faced serious challenges due to its excessive debt. To stabilize, GE made significant corporate finance decisions, including selling off key assets such as NBC Universal and portions of GE Capital, raising billions to reduce debt. The company also implemented cost-cutting measures, streamlined operations, and reduced its dividend to preserve cash. These actions allowed GE to strengthen its balance sheet, refocus on core businesses like aviation and healthcare, and ultimately improve its financial health for the long term. Section 4. Conclusion. In summary, corporate finance is at the heart of every successful business. From making strategic investment decisions to managing the day-to-day finances, corporate finance ensures that a company can grow sustainably while managing its risks and maximizing value for shareholders. It's a complex but vital area that requires balancing long-term goals with short-term needs. That wraps up today's lesson on corporate finance. If you found this video helpful, don't forget to like, subscribe, and leave your comments below. Thanks for watching and I'll see you next time.